The Canadian real estate market is in absolute chaos right now, with some properties losing as much as $235,000 off of their peak values. And I'll show you a few of those a little bit later on. But depending on where you are, who you're talking to, this can either seem like an absolute catastrophe or a massive opportunity. And in today's video, we're going to discuss the realities of the Canadian real estate market in 2024 and what this means for you if you're a buyer, if you're a seller, and what the stats are telling us about what happens next. And depending on the way you look at it, it either might be really pretty or not so pretty at all. But before we get into it, my name is Nolan Matthias, and if you want to thrive financially, this is a place for you. So do me a favor, hit the subscribe button, hit the like button so more people like you can see this video. And don't forget, you can still get my book, Mortgage Secrets, totally for free at mortgagesecrets.ca. All you have to do is pay the shipping and handling. Okay, so we're going to try to do this one in one take and just rip through all of the news here. And I'm going to start by showing you a whole bunch of graphs. And some of this is a little bit scary. Or if you're a buyer in certain markets, some of this is kind of exciting because there are some deals out there to be had. So here's a look at the graphs. And I'm going to go ahead and give full credit where it's due here. All of these graphs today are courtesy of Edge Analytics. This is my go-to source for real estate information, done by Ben Rabideau, who has been a guest on the live stream here. And he has some of the best stats and the best data. And I pulled from his July report the stuff that's most relevant to the real estate market. And we're going to start first and foremost by talking about the CPI rented accommodations, because when it comes to CPI and inflation, rental accommodations make up a significant portion of the increase in CPI data, which is essentially inflation over the last couple of years. And if you take a look at this, the cost of renting right now is getting absolutely insane, which for many people, that means that renting is no longer the best option, especially as deals come to the market in the condo market. So there's this really interesting adjustment happening where rent's becoming more expensive than owning. And if you're one of those people who's been renting and you're seeing your rents climb and climb and climb, there's a really interesting way, a good way to get out of that rabbit hole. And that is by starting to take a look at actually purchasing a property, especially, like I said, as prices come down on condominiums pretty much across the board, across Canada, with a few exceptions. Now, one important thing to note here is that this makes up for about 0.6 of inflation. So in other words, when that inflation number comes in at 2.7%, if you were to take out the CPI rental accommodations, it would bring inflation down to about 2.1%. So that's good news from an overall inflation standpoint, but bad news from the perspective of how much it costs you to live in a home right now. Then as we move into housing starts, and I'm going to go through the housing market, I'm going to go through what's for sale, I'm going to go through interest rates and what's happening there. So we're going to cover everything in this video. If we take a look at housing starts, what you can see is that even though the government is adamant that we need more housing starts, we need more houses for the population that is ever increasing, housing starts are actually coming down. And this has a lot to do with the economics of building a home or a builder building a home right now. And in a second here, you'll see a little bit more about what they're building. But what this tells us is that interest rates are still too high to encourage a builder to get into the market and to be able to have the confidence that when they build, their interest costs aren't going to eat away at all of their profits. So this is where the Bank of Canada comes into play. And obviously they've started to bring rates down. But if they don't continue to bring rates down, the new home supply could just continue to get lower and lower, especially when you look at it relative to the overall population. Now, what's interesting here is what's getting built. So dwellings under construction, obviously the condos from 2021, 2022, 2023 are still very much on the rise. These were often sold as pre-construction. They are still under construction, and that's why we have so many condominium units that are still under construction. You'll see some interesting data on that and the problems that's causing in Toronto in a couple of minutes. But when you look at the rental construction, this is where it gets really interesting because never has there been more rentals being constructed. In fact, the share of rentals, which I'll show you in a second, relative to the overall construction is the highest that it's been in recent memory. Now, this creates an interesting issue because when you look at single family home construction relative to condos and rentals, what this means is that potentially somewhere down the road here in the next 5 to 10 years, we are going to face a single family home shortage, which means your options are going to be to buy condos or you're going to have to pay a premium to live in a home that is not attached to somebody else. So we're solving one problem, which is the lack of housing, and we're creating another problem, which potentially is the lack of single family housing in the near future, whether that's 5 years, 10 years, 15 years down the road. So pay attention to that. And if you are a condo owner right now and you are thinking that somewhere down the road you're going to want to be owning a single family home, pay attention to these numbers because your opportunity to buy a single family home, if there does in fact become a shortage, could start to go away. And it could get more and more expensive to own a home that's not attached to somebody else. So if that's something that's on the horizon for you, something to consider. Now, when we look at housing starts, on the other hand, you can still again see that the single family homes are significantly less than condos and rentals, but those condo starts are starting to come down. And this is because of the decreases in prices and values of properties that are coming to completion, condos that are coming to completion, and the fact that there's just zero market for pre-construction sales right now. So even though there's lots of condos under construction, there isn't a lot of new condo buildings being built because there's just this influx of condos that are about to come onto the market, which means we're probably going to lose a lot of the new construction of those condos very, very soon. Now, moving into purpose-built rentals, and this is what I was talking about with respect to the percentage of total properties being built. Purpose-built rentals are now almost 40% of all properties that are being built. Never in recent memory has it been this high. It was that way in the early 90s, but really what we're becoming is a renter nation. We're creating more and more rentals and less properties that are built and designed for ownership, which again could be problematic in the near future here. Now, this is where it gets really interesting because if you watched, and you can watch my Toronto real estate update from last month, basically, Toronto new condo sales have plunged by 57%. And this is hit by the fact that all of these new condos are coming to completion and they're hitting the market as essentially resales. So now there is a significant number of condos that are sitting on the market, and wait till I show you, sorry, the drop in prices that are happening as a result a little bit later on here, because it is staggering, absolutely staggering. And with all of those condos and the price floor not really found yet, and developers not knowing what the floor will eventually be, well, they're just not bringing as many condos online, which I don't have to explain is going to lead to a further housing shortage somewhere down the road. And then when you take a look at single family building permits, and this is where I think we're going to face a significant issue in the future, you can see that less and less builders are opting to build single family homes, which means, like I said, there's probably going to be a shortage of supply here, especially as millennials leave the condominium lifestyle and try to get into the single family home lifestyle. Now, contrast to multifamily building permits, and you start to see that, these were up quite substantially, but again, starting to fall. And this is because of the influx of condos that are being completed and that 57% reduction in prices that is happening, or 57% reduction in number of new condo sales that is happening as a result of all those new condos coming to market. So this is interesting. We're turning a table. We still have the population growth, but we're starting to turn the tides on how much is actually getting built. And the stuff that is getting built to be rented, not to be owned, which has a significant impact on the potential future wealth of Canadians. Because when you look at the wealth of Canadians, the people who have the highest net worth nearing retirement are those who have owned a home, and the numbers are staggering. It's essentially, if you've owned a home at 65, you typically have a net worth in the $1 million range. But if you've rented all the way up till being 65 years old, you typically have a net worth in the $20,000 to $30,000 range. And those are Stats Canada numbers. You can't deny that home ownership builds wealth, but the type of properties that we're building right now are designed to make sure that people aren't going to be able to build wealth. So that's a major issue going forward. And this is something that's going to take years to play out, but it's something to be paying attention to. And definitely, if you are renting right now and you've got an opportunity to buy, it might be the time to think about it so that you don't get left by the wayside and not have the ability to buy a single family home somewhere down the road because they just don't exist anymore. Then when you take a look at population change by Canadians and US metros, what you can see is that of all of the cities across North America, we have at least one, two, three, four, five of the top 10 fastest growing cities by population are in Canada, which is insane because our population is 30, 40 million, US is 300 million, yet we've got multiple cities in the top population change, which is just insane. So, moving into the mortgage stuff, moving away from the real estate stuff for a second, we'll come back to that in a minute. You can see what's happening with prices in a minute and whatnot. But when we take a look at residential mortgage growth, you can see that this has fallen to a low not seen since 2010. And I'm going to guess the numbers in 2007, 2008 were pretty similar to this. But what this tells us is that less people are borrowing, less people are buying houses. And as a result, all those rentals are being built. We're running the risk of very much becoming a renter nation. And when you look at the 5-year Bank of Canada policy rate outlook, what you start to notice is that there's a significant feeling among Canadians that interest rates are going to come down and come down substantially. Now, I don't know if these rates are going to come down by 1.5 to 2%, but what you can see is that people are definitely thinking that interest rates are going to come down quite substantially. And that's leading more people to choose 3 and 4-year mortgages. Now, is this the best idea? Well, what if interest rates don't come down? And you're paying essentially the same for a 3 or a 4-year mortgage as you could pay for a 5-year mortgage. You're leaving yourself exposed. The other aspect of this is people think that if they get a 3 or 4-year mortgage and that Bank of Canada rate does come down, that they're going to be in a situation where they're going to be able to get a lower fixed rate and they're going to be able to time the market. Well, timing the market is the thing that makes good people make bad decisions. This is why everyone took variable rate mortgages thinking that they would be able to get, a really good leg up on the market and then tried to lock in and everything else like that. And the circumstances just didn't play out in the normal way in which it should, where you should have been able to do that. Well, what if they don't play out that way this time around? So the people don't realize that when you look at the 5-year fix, the 3-year fix, the 2-year fix, that those interest rates are very much pricing in the Bank of Canada rate changes that are expected. They're priced off of the rate expectations for 1, 2, 3 years out. So the chances of at year 3 getting a significantly lower interest rate, even if the interest rate expectations do play out, is actually not as high as many may think. So in a lot of cases, it may make a lot more sense to get a 5-year fixed mortgage and just wait it out for the full 5 years so you're guaranteed the rates for the full 5 years. Now, with respect to variable rate mortgages, a lot of people taking these because they think interest rates are going to come down, but keep in mind that if you're paying 1% more for a variable than you are for a fixed, you don't need interest rates to come down by 1%. You actually need them to come down by almost 2% because all of the time that you're going to spend paying the higher interest rate has to be canceled out before you break even. And then however long that takes, whether it's, let's say that happens over a 2-year period and you see a 2% rate reduction over a 2-year period, well, then you might get 3 years where you're saving some money. But the reality is the fixed rates are priced so low right now that if you were to run a Monte Carlo simulation on this, which is a fancy word for doing a whole bunch of simulations around different scenarios, there's a really good chance that you will actually never see any sort of savings by taking a variable. So if you're going to choose a mortgage right now, I think you should be choosing a 5-year fixed and making sure that it is not with a B lender. What do I mean by a B lender? A bank. Banks are B lenders. B is for banks. And when you have mortgages that have high penalties where everything else is pretty much the same as all of the other non-bank lenders, it makes no sense to get a mortgage at a bank. And if you do, you're going to find yourself in a circumstance where you have a massive penalty. And if interest rates do come down, you aren't going to have the ability to negotiate your 5-year fixed into a lower rate. So pay attention to that when you're looking at choosing your mortgage. And by the way, in order to choose the right mortgage, you need a good mortgage broker. If you want a great mortgage broker, my team at Mortgage 360 is happy to help you. They do a full risk analysis. They talk about the possibilities of rates going up, rates going down, and they actually help you understand the mortgage that you're getting instead of just looking at it as an interest rate and a term. Because mortgages, I don't need to tell you this, especially if you got a variable rate with a bank over the last couple of years, are a lot more complicated than just the rate and the term. So make sure that you get the right mortgage. Make sure you have somebody who's willing to advocate for you and whose job it is to advocate for you, because the bank employees, well, their job is not to advocate for you. It's to make as much money as they can for the bank. Now, some interesting stats here. What's interesting is that when you look at the different mortgage books across the country, TD residential mortgages are up substantially. And this is in contrast to a place like Bank of Nova Scotia, who lost a little bit of business from the broker channel recently. They weren't really competitive in the pricing market. And as a result, their book of business is quite down. But I've said in the past, if you're going to get a mortgage at a bank, Scotiabank has the best mortgage. I do think there's other mortgages, depending on what you're getting, that are more competitive than the Scotiabank mortgages. But if you are going to get a mortgage at a big bank, Scotia is the place to do it. And watch out because they've seen these numbers, they know where they're at, and they are getting more and more aggressive every day, which means there's some really good deals to have at Bank of Nova Scotia. So if you want a really great rate right now, talk to my team and they will be happy to set you up with a Scotia mortgage if it's the right mortgage for you. And if it's not, they're going to offer you something way, way better. Now, moving into home sales, this is really interesting. So seasonally adjusted home sales are actually up for the first time this year. Now, this is a bright light in a very dark real estate market because when you look at really what's going on across the country, we only see two markets where home sales are up. They're Alberta and Quebec. And those two markets, as you'll see in a second here, are actually having values that are increasing. Now, a lot of the rest of the country is seeing lower home sales. This is especially problematic in places like BC and Ontario, where they have all these new construction condos that are under construction that are about to come to market, which means there could be some significant softness in the market. And there's definitely going to be some really good deals, which I'm going to show you in a second, some of the deals that have been had recently. Now, when we look at the Canadian home sales per 1,000 people, and this is quarterly and it's seasonally adjusted, so it's based on the time of the year, what you'll see is that we're below average for the number of sales per 1,000 people. So, especially with that increased population, this is really pushing those numbers down. But in the grand scheme of things, when you look at 2020 during the pandemic, when you look at 2008 right after the financial crisis, and the year 2000 right after the dot-com bubble burst, well, we're actually not as bad as it's been in the past. Now, only time will tell where this goes, if it gets worse, if it gets better. But from a sales perspective, we're actually not in as bad of a place as you might think, or some of the media might have you think. Especially look at that 57% reduction in new condo sales number. Like that's a scary number. But when you look at it from a where we're at relative to the average, it's actually not that bad. And depending on the market, it's actually really good. And then if you take a look at new listings, this is interesting because we're seeing the new listings come back up to their normal levels. That's the red line here. And that is a very, very positive sign for the Canadian real estate market because what that means is that we're heading towards normalcy. And if you're a buyer, what this means is that there's going to be an opportunity to buy a home without having to panic, without getting into bidding wars, and actually be able to get a good deal. Wait till you see the deals I show you that people got at the end of this video. And then when you take a look at active listings, now the active listings numbers are coming up, even though the new listings numbers are kind of all over the place. And this is largely to do with the fact that properties are sitting for longer. And when properties are sitting for longer, that means buyers have an opportunity to negotiate, get a deal. As somebody goes, well, aren't houses supposed to sell in 5 days? And at 35 days, they're going, what the heck is happening? And they just want to get it sold. So keep that in mind when you're shopping for houses, especially in markets like Ontario and BC. There is an opportunity to get a deal. And if you look at the days on market, which shows up in the MLS listings, if you look at those days on markets and there's a significant amount of time between when they listed and now, well, that's usually an opportunity to go in, have a little bit of a lower ball offer and get a little bit of a deal. And then this is how this is playing out on the benchmark house prices. Now, obviously, this came off of its highs in 2022. We saw a little bit of a bump up in 2023, and now we're seeing it flatten out. And my expectation is that this is probably going to look a lot like 2016, 2017, where we see some flatness over the next couple of years. Now, if you're waiting for the bottom to fall out of the market, could that happen? Possibly. But if it doesn't happen, and this is what happens, really what that means is that right now, when interest rates are a little bit higher, there aren't as many buyers, and there's more listings on the market. Now might be the opportunity to get a really good deal. And then you marry the house and you date the rate. And what that means is that you end up trying to get a lower mortgage somewhere down the road so that you can ultimately buy a house for less right now and renegotiate your mortgage when the time comes so that you can save the money on that. You'll be able to get into the market when there's less competition. And if it's the right time for you, it's the right time for you. Go out and find a deal. Now, changes in Canadian housing prices. This is interesting as well. We're starting to see this first bump up we've seen since January. Again, seasonally adjusted. So this accounts for the fact that it's summer or late June. And then just taking a look at MLS house prices across the country, you can see in Calgary, sorry, that prices are up over 15%. And you can see we've got a little bit of a bump up in Edmonton. We've got a little bit of a bump up in Montreal. And those are very much bright spots in the Canadian real estate market. So if you're looking in those markets, by all means, you're going to be getting into a little bit more of a competitive situation. But anywhere like Hamilton, Kitchener, London, Ottawa, Toronto, where these prices are down, well, there's probably an opportunity to get a really good deal on a home in those areas. And then just taking a quick look at the RBC Affordability Index, you can see that this is well above what it normally is. Basically, condo apartments right now are what's deemed affordable from an affordability standpoint. The last time it was like this was in 1989, where condos bumped up above the average or the affordability baseline. And if you take a look at various different cities, you can see that Vancouver condos are now the typically affordable properties. You can see in Toronto, it's the same sort of thing, which means that the buying has moved from single family homes to condos. But then take a look at Calgary. Houses are still very much affordable no matter what type you're buying. Condos are very much affordable. And then Montreal kind of has the same picture as Toronto and Vancouver. Now, I want to show you these graphs or these charts. These are two listings from the Toronto area. One is from Brampton, the other is from Mississauga. And take a look at this. Houses that were bought in 2022 for $725,000, selling in June of this year for $487,000. That is about a $237,000 loss on those properties. And what's crazy is that these guys tried to sell this property in October. They started at $588 and they ended up selling it for $100,000 less than what they wanted to sell it for basically 8 months before. So if you're a seller, the lesson here is don't price high, price it where you need to have it to be for it to sell. Because if you don't, you could end up following the market down. If they would have just priced this at like 525, 550 back in October of last year, they probably would have sold it and they probably would have saved a whole bunch of money. But because they tried to get the price instead of going where the market was, they lost. And then take a look at this one. Same sort of thing, $850,000 down to $525,000, and almost the exact same program here where they listed it too high and they followed the market down. If you're selling a property, don't chase the market down. Price it where it needs to be. Price it just under what all the comparables are so you can get rid of it, so you don't end up in a situation where you basically take an 8-month hit because you get attached to the price that you really wanted to have. So that is your Canadian real estate update for July/August of 2024. And if you want to check out what's going on in the other markets, especially in Vancouver, because that one is a seriously interesting story, make sure you check out this video right here.